You know what it means? If you don't know what it means, you might not be aware of trading volatility, entropy, probability, and statistics. Fortunately for you, I know what it is, and I can explain it to you, which is exactly what I'm going to do in this video. And even if you do know what it means, maybe you just need to hear it. And maybe you just want to know what the particular forecast means. I'm talking about the new tight weekly range of the VRE on Bitcoin here in this last week of February of 2024. Well, what does it mean? Well, last night or this morning or whatever time zone you're in, there was a new weekly candle set on Bitcoin, and the range for that weekly candle, the current new one, is tight. It's in fact very tight. It's at about 0.04% of the asset's value, and that means, in all probabilities, it is very probably a trending week. What does that mean? It means we're likely to see trending moves on the week, and specifically today, if you look at the new daily range of the VRE, it is also fairly tight at about, 0.14%, I think, something like that. So still very, very tight. Far less than 1 or 2%. 2% is usually the threshold between trending and ranging widths of the VRE. And so when it's as low as 0.14% or 0.04% as it is on the weekly, those are very trending ranges. And what does that mean? Well, that means that on the day, it is very probably going to be a trending day. And you can see that if you look at the intraday monitor time frames, like the 15-minute time frame and lower. There's already been some nice trending moves on the 15-minute, and there are likely to be more trending moves in the run-up to traditional market open and shortly thereafter, and again by end of day. How do I know that? Well, I know that because I know how to use the VRE chart provided by our very own VRE charts made with our very own VRE indicators and Laplace distribution band indicators and normal distribution band indicators, so that we can see the VRE as well as the Laplace and the normal distribution levels. And then when you have those three indicators overlaid on the same chart, you can see very clearly where these levels are. Now, what are these levels? Well, they're really distribution levels, and what they tell you really are kind of price magnets based on the volatility and the returns, standard deviation of returns, Laplace distribution, etc. And it shows you very accurately where the price is likely to move to and fro in any given time frame, what the range is likely to be, what the range is actually, and what the movement within the ranges is likely to be between targets. Now, how can I be so sure that it's effective and that it works nicely? The answer is I use it a lot, all the time, in fact. And I can see very clearly that the daily range, which is trending, has already had trending moves, mostly to the downside so far today. But there was one little move up. And on the lower time frames, 10 minute, 9 minute, 6 minute, 5 minute, 3 minute, 1 minute, etc. You can see plenty of trending moves happening today so far. And again, it's likely to happen more in the run-up to traditional market. Trying to front run or get their positions in before market open, and then either take their profit at or around market open, if it's going their way, or if they're greedy, they're going to stay in their position, wait for it to make the next move, and if they don't get wrecked by that, either they'll take profit if they're smart, or they'll hang on again, see if it'll run further in their direction. And very often, people who are over leveraged will get wrecked because they were greedy, and rather than taking profit, they wait for the volatile asset to turn around and eat away all their profits and put them back at zero or worse. And this happens all the time. You can see it on liquidation charts all over the place. Plenty of websites that have that kind of information if you know where to look. You can go look at CoinGlass, and I'm not shilling them or anything. I don't really care if you use their site or anybody else's, as long as the information is relatively accurate. That's what matters. So you can look up their liquidation map or anybody else's liquidation chart, and you'll see that on any given hour, on any given day, there's tons of people getting wrecked in longs and in shorts on any given asset that they chart. Why? Because people use too much leverage, right? So even though you have a trending day within a trending week, and even if people get in the right position and they're in a winning trade, the amount of leverage they use is going to put them incredibly dangerously at risk of losing it all if the price action moves even a tiny bit against their position. And you see all the time happening on these crazy wicks that happen because somebody bought towards the top of a candle. It wicked up, they didn't get out of profit, it turned around, or they bought at the very top of the candle, it turns around, it goes down, creates a wick by the time the candle closes, and that little wick is enough to liquidate that trader's position, and it happens over and over and over again. So once again, do not be greedy, right? Trade as a boss, trade without any emotions. Don't be emotionally attached to your trade, because that is the poison that will get you psychologically and financially. And leverage is the poison that the exchanges will give you to make you think that you're making huge gains easily, and then just as quickly they'll take it away from you as soon as the price action turns around. And they know that because of people's greeds that they're going to be collecting most of that money, if not all of it, pretty much all of it, very soon and very quickly. That is literally why they offer it, right? Think about it. Why would an exchange give anybody the power of leverage on a volatile asset like crypto? Do you think it's because they want you to be a successful trader on their platform, consistently profitable, outplaying the whales and the exchanges that are trading against you? Or do you think it's because they know that it's an easy tool for them to use to, quote unquote, give you free money and then take it right back from you? Think about the logic of that. Do you think the exchange is in the business of giving you free money? Because if you think that, you got another thing coming. They're not in the business of giving you free money. They're in the business of taking your money. And they do it extremely well. And if you think your small little position isn't enough for them to target, well, you got another thing coming, which is you absolutely are the target for them, even if you have like a $10,000 or $5,000 or even a $500 account. Trust me, I've worked in that field, and they'll have meetings about that. And this trader's deposited $500, and now he's up to $1,700. He's more than doubled or tripled his money in a week or two or a month. How do we get his money? It sounds ridiculous, but they do it. And I worked for a quote-unquote very legitimate trading platform. platforms really, and exchanges, trading all kinds of assets. And they will absolutely have meetings about people who are making $500 a week consistently, not losing money overall, or making $5,000 or $10,000 a week or a month. And they will absolutely target those players or traders. And many of them view themselves basically as casinos, right? And they know that they are the house, therefore they have an advantage. And in an unregulated market like crypto, they will absolutely use that advantage against you as a trader. So keep that in mind. Don't be a sucker. And remember, if you're trading with the VEPs, know that on Bitcoin, this is a trending day within a trending week. Keep your eye on the low time frames. Look for the trending moves. Look for the information that matters, the volatility correlation, the entropy in this correlation, the variance in this correlation. Look for all that information. Look for the returns. For divs on the returns or divs on the entropy oscillator. Look for all these things. Look for the moves on or about the RMLR, right? The third standard deviation bands up or down, and therefore mean reversion will follow after it stops hitting those third bands, the third standard deviation bands, right? Look for all those indications. Look for the primary information. Look for the secondary information. If you have confluence on 3 or more indicators, there's very likely confluence on far more than just 3 indicators. So keep that in mind. And happy trading. Cheers.